All right, good morning, good afternoon. So this video will be on time. Everything, every single asset class or any technological device or software that is programmed by an algorithm, it is based on time. The first principle of algorithmic theory is time. Whether it's YouTube algorithm or it's the Instagram algorithm, or any of the algorithms. For example, for YouTube algorithms, there is times, there is a time window within the morning time frame when there is a lot of traffic generally in the whole world. So within that time frame, specifically using New York time frame, within that time frame, doing in the whole world, typically most consumers come online to use YouTube during that time frame in the morning for New York. So same is it in trading in all asset class. So because the market is controlled by an algorithm, the market delivers with time. So every major swing and every major reversal in price action is can be predetermined using time. And as professionals and as smart money traders, time is very crucial for us because this is our job, this is our work. In every profession you have time to come on to work, and you have time for your lunch break, and you have time for when you go off, when you go back home after work. So same is this for this profession. So there is no, when talking about time, there is no ambiguity about it. Time is a constant. If it's 2 p.m., it is 2 p.m. If there is an injection of liquidity within the 10 a.m. to 11 a.m. window, that is what will be programmed into the algorithm. So that's how it is. And as I was saying, as smart money traders that trade with the perspective of algorithmic theory, we time is very crucial for us. So I'll just jump right into it. Time is very crucial for us in the sense that because we can predetermine when a major swing or a major reversal in price action or an expansion leg in price action is to be expected, we can therefore program our days to align with this algorithm, or inversely, we can program the algorithm to align with our day. Does that make sense? Let me make that as clear as possible as I can. So because we understand during which time windows liquidity is being injected inside the market, which is the morning session for New York and the afternoon session for New York. Typically, there's 3 windows of trading where the indices market is a tradable market. So, which is the London session, which is London, and London is 2 a.m. to 5 a.m. This is London's window, and this is a tradable window for London session. And then you have the New York opening, the New York AM session. New York is AM session, which is there's 2 opening prices for the New York session, for the New York opening session, the New York morning session, which is the 8 a.m. opening price and the 8:30 a.m. opening price and the 9:30 a.m. equities open. So you say the 08 30 09 30 to 12 a.m. So this is the trading window for the New York morning session, and for the New York PM session, which starts by 1 the New York PM starts by 1:30 1:30 p.m. to 4 p.m. So this is the New York PM session. So this is the three tradable windows for the indices market. The indices market is mostly idle or in a range bound price action during the Asian session. So we stay away from this session because there is almost little or nothing except you are holding a trade from either of these sessions through the Asia session. So within these three time windows, as a trader, you have a life, you are human, so you have other things you're doing with your life. So within these three time windows, you only need 1 hour inside of it, within it. You only need 1 hour from one, not 1 hour within the three of it. Just 1 hour from one. So your 1 hour can be the 2 a.m. to 3 a.m. or the 3 a.m. to 4 a.m. or the 4 a.m. to 5 a.m. window. So just 1 hour. You only need 1 hour to make money or to participate in the market. So that's 1 hour. For the New York session, same thing. So you only need 1 hour of time window to participate in the marketplace. And within that 1 hour time frame, you study the algorithmic theory, which will be which presents itself most times than not within that 1 hour, and you backtest it. You get your data for that time frame and understand um, its characteristics. So in picking this time frame, you have to make the algorithm work for you and not you be its slave. Let me explain. Let's say you're a student and you get off, you are occupied from 8 a.m. in the morning until, let's say, 2 in the afternoon. So you are occupied all through the morning, all through noon. Then you are free for you get off school from 2 p.m. So let's say you get off school from 2 p.m. You would have to eat. You have to get something to eat. You have to relax and rest. You can rest for you can get something to eat for like 30 minutes and rest, calm your brain for another 30 minutes. That's a 1 hour window to get yourself set up. So as a student, you time in this aspect is crucial to you. So you can make the 3 p.m. to the 4 p.m. as your 1 hour time window to participate in the market, which is the afternoon session. So you have to tailor your lifestyle to match with how you want this algorithm to work for you. So let's say you're working and get you only get off lunch, let's say 1:12 to 2. If it's that for you, you can trade within the 1 p.m. to the 2 p.m. 1 hour time window. You want to arrange your time in the market to work with your time in your life, in the real world, in what you have going on. So same goes for the market. So as you can see from yesterday's trading, the London session made its high here and price rallied lower. And when we have you have the opening price for the London for London's trading is the midnight opening price. Let's call this 40. This is the midnight opening price. So this right here is the midnight opening price. And you have the opening price for the New York session, which is the 8:30 a.m. opening. This is the 8:30 a.m. opening. Now, write this down in your journal. This is for those interested in participating in the PM session. So this is it. When you have the New York morning session fail to trade above the 8:30 a.m. time window, this is price indicating when you're bearish in price action, you are typically expecting an accumulation leg, after which you have a manipulation leg higher. This is the manipulation leg, and then you have the price makes the real move to go lower. So this is what you're expecting when you're bearish, buy side being purged and sell side being swept. Now, when you're bearish for the day and the morning session and you're trading the PM session and the morning session fails to trade above this 8:30 a.m. opening time, as it did here, it failed. As you can see, the morning session after 8:30 to 12 p.m. price fails to trade above the 8:30 a.m. window. This is the algorithm indicating to smart money traders that price is extremely bearish for the day, for the intraday move. So when you come for the PM session, you come with a bearish notion, a bearish bias. So for the PM session, the opening time is 1:30 p.m. So you map out the opening price for it, which is this. This is the opening price. So you have launch behind it. So launch took place within the from 12 noon to 1:30 p.m. So that is the launch. That is for launch. Every time price rallies higher immediately after this 1:30 a.m. window, you are looking for something like this. You are looking for price. You are looking for that leg higher as a manipulation leg in price. So that's rally, that price rally that goes higher, you note it as a fake rally. So that won't phase you. That prices has made it its low here, and it's interested in higher prices. So say you're participating in this New York PM session and this is the 1:13 a.m. window. So you are using the 2 p.m. to 3 p.m. as your trading window for the PM session. That is your 1 hour for you to operate. 1 hour being within that 1 hour, your entry, you get a form of entry inside that 1 hour. If you do not get your entry within that 1 hour, then you leave the chart. And if your entry forms within that 1 hour and you have to and price doesn't go inside your entry, you can set a limit order, because price can still trade back inside your entry as long as the time window for the session has not elapsed. So the time window for this is 4 to 130. So this is what we are working with, this little time window, 4 to 130. So let's see lower time frame. So as you can see, we noted, so because price has valid above this 1:30 p.m. opening price, this rally is seen as a fake rally. So we are watching this rally diligently, waiting for price to shift sentiment from a buy manipulation, from a uh, buy program manipulation to a sell program distribution, which it does, here. But all this is hindsight. So hindsight is always 20/20. So that's how it is. And this is the last up close candle from this 5 minute time frame. This is the last up close candle that price before price dropped lower. So this is the bearish order block. So for an order block with a long wick like this, you use the wick of it. You use the low of the wick, the midpoint of the wick, and the opening of the wick. So here you have the bearish order block. So on your own, you can look for the midpoint and the end of it and the high of the wick. So this is what we had here. So if you are trading the 5 minute time frame, this is your indication to go in, because price has changed its direction and giving you, because you are bearish, you're expecting lower prices. So here this is your drawn liquidity. So you note this as your drawn liquidity. So here you have your drawn liquidity, and you have this liquidity pool here, and you also have this liquidity pool. And if you take your Fibonacci from this low to this high, if you take your fib from this low to this high, when price made this last up close candle and dropped lower, your limit entry will be here. Your limit entry will be on this other blocks low, and your take profit should be first at this equilibrium and at a discount PDRA. So what discount PDRA can you identify within this leg up? What discount PDRA can you identify? Just look at the chart before I reveal it. No need to pause, because most people won't pause typically. So here you have this mitigation block here, and you have this fair value gap here, this imbalance here. So you do not need price to trade down to your dawn liquidity, even if you did that here. But this is all hindsight. So this is by the way. You do not need price to trade lower there, because from your other block, you're risking about 6 handles to get off at 14 handles, which is the eye of this fair value gap. So you have the eye of this fair value gap here, and you also have the low of the fair value gap. You do not need to wait for price to trade to this low before you bank something. You can take some off from this equilibrium point. You take some off here, and maybe at the midpoint of this fair value gap. And if you drop lower, you can see. So this is your personal, this is your 1 a.m. time window. Say you're trading the 2 p.m. to the 2 p.m. to the 3 p.m. time window, which is this. So this is your time window. Yeah. And as you can see, the other block from the 5 minute time frame, this is what it is being transposed here on the 1 minute time frame. And as you can see, price chased lower here after making it high here, after taking out buy side liquidity here, because our John liquidity was here and we're expecting lower prices because of the narrative from the AS, the New York AM session failing to trade above the 8:30 a.m. That is one of our indication that price is extremely bullish and bearish for the day. So price dropped lower here after the first 30 minutes. So you want to wait to see what the first 15 to 30 minutes of your time window presents to you. Most of the time, not all the time, but most of the time. That is a general rule of thumb for me personally. So as you can see, price trade lower and left this gap here and this gap here. So when price leaves gaps like this, you anticipate price can trade inside of here, but because of narrative being this is a breakaway gap. I keep saying later we'll discuss the hierarchy of fair value gaps, but not now. That will be later video, later in the mentorship. So you have this breakaway gap. When a breakaway gap is seen in price action, you do not expect it to be filled. And you have a fair value gap formed below, just below this breakaway gap. So you note the fair value gap, the high of the fair value gap and the low of the fair value gap. And you place your limit order on this low of the fair value gap. When you are bearish, the best fills forms below the midpoint of a PDRA, and when you are bullish, the best fills forms above the midpoint of a PDRA. So this is the midpoint. Let's say hypothetically this is the midpoint of this, and you see price just the body close at the low of this fair value gap here, and price dropped lower here, engineering sell side liquidity. Now when price makes this type of clean lows here, retail traders will see this as a sharp support, a strong support that can never be broken. This is what the algorithm wants. It wants to deceive and manipulate. And you, as smart money traders, you want to see this manipulation in price action because you are to use it to your own advantage. You are not complaining that there's manipulation in price action. You are happy that this is rigged because it gives you a fighting chance if you can take your time and put in the work to learn. So because there is something you can do about it, you can't be fearful or anxious about it. So when price made this lows here, this is price engineering sell side, more sell side, because it is not just looking for this sell side liquidity here and this sell side liquidity here. Price is looking for the as much victims as possible so it can create more victims at the spot. Not just these victims that are here and these victims that are resting below this relative equal lows. Price can still form new victims, new meat. Does that make sense? So when price drop lower here, retail will put their sell stops below here and price chase back up just to tap this, the low of this fair value gap, which coincides with this rejection block here. So you have this rejection block here. We'll call it RB because I've not talked about a rejection block in this YouTube channel, but maybe later on we'll talk about it. So this price trades to this rejection block, and so this is what we have. with you can take something off here when price trades inside of this imbalance and below this relative equal lows down to this fair value gap. This is the fair value gap from the 5 minute time frame. This is it being transposed there on the 1 minute time frame. So you can use this as your fair value gap to get off. You can use this as your fair value gap to offload your remaining position, and this as your final take profit, even if here is your dawn liquidity. So you do not need price to come to your low to exit. So this is what we had here for yesterday's price action for the PM session. So this was the business. What's this? So as you can see, when price trades up inside of this, below this, the low of this fair value gap, there was a limit order here. As you can see, the high of this is 548. Look here, look at this, pay attention to this price points because you are interested in only time at this x-axis and price at the y-axis. So this is it. So here you have the high of this candle here of this 1441 candle is 5480.2, and the low of this fair value gap here is 54,979.5, and the entry is just at a round figure 5480. So I don't know if you can get anything as more perfect than this. So this is as precise as you can get trading Michael's concept, ICT's concept, because it is a precision based concept. And as you can see, we rallied above again here. Then we pyramided a position also here. As you can see, these are all limit orders. I do not enter with market orders. If you know what you're doing, you will not enter with market orders because you are giving yourself up to your brokers to slip you, to provide you too much slippage as much as they want, and you do not want that. You want to maximize your profit in this marketplace because you pay commission every trade you take. So you want to maximize your profits as much as possible while you minimize your loss as much as possible. So entering here, your stops above this candles high here, and your take profits below this relative equal lows, inside of this, the low of this fair value gap, because it's as a discount of this range from that low to this high. This is the equilibrium of that range, and you have this as a discount PDRA. So these relative equal lows are discount PDRAs, and this fair value gap here is also a discount PDRA. Yeah, so we sold from a premium to a discount. So when price traded back down, up, when price rallied higher back to this low of this, which corresponds with this rejection block, as you can see, the rejection block is 5479.5. The high of this candle is 5479.5, and the entry is 5479.5. You cannot get as precise as this. So this is as precise as it gets. So these take profits are limit orders. So you take profit here at this. This was take profit, but slippage took it lower. So this is why you always enter with limit orders. So take profit was here, price dropped lower, and take profit was above or at the high of this fair value gap here, as you can see. So sold 6, sold 4, covered for 6, and then covered for 4. So hope you got something from this video. We'll talk to you next week, and have a great weekend. Rest if you want and study if you want, depending on your state of being and frame of mind. Don't neglect your rest time, because that is when you recharge back. So goodbye.